Howdy folks, I'm James and welcome back to CryptoSnap. Today we're taking a little look at the thorny topic of crypto and securities after a California resident, a Mr. Mark Young, brought litigation which may have far-reaching implications for the space. His suit, which was filed on the 1st of July in the District Court for the Northern District of California, targets Solana Labs, the Solana Foundation, its co-founder Anatoly Yakovenko, Multi-Chain Capital Management, and its co-founder Kyle Samani, plus Falcon X. He's accusing them of selling and promoting unregistered securities in the form of SOL tokens from March 24th, 2020 onwards, the day Mr. Mark started investing. If you don't know it, Solana is the 9th biggest cryptocurrency by market cap and is a very popular DeFi token with a focus on transaction speed and scalability. It can reportedly handle over 50,000 transactions per second, in contrast to Ethereum's 30. So no crazy gas fees when you want to buy your next PFP NFT, OMG, wag me. Here's an extract from the lawsuit.
The defendants made enormous profits through the sale of SOL securities to retail investors in the United States in violation of the registration provisions of the federal and state securities laws, and the investors have suffered enormous losses.
But hang on, let's start at the beginning and keep on going until we get to the end and then we'll stop. What's a security and why the hell do I care if Solana is one or not? And how's this lawsuit going to affect my portfolio? Well, to answer that, we actually have to go back to fair 1940s Florida where we lay our scene. The Roaring Twenties were by now a distant memory. War was on everyone's minds. People craved a bit of certainty. So the Howey Company, which was a citrus grower, came up with an ingenious solution. Why not sell half its groves in real estate contracts to finance its future business developments? Investors would then lease the land back to the company, which would continue all the work as they had done beforehand, tending to trees, pruning leaves, stroking oranges, and whatever it is that orange growers do. And they'd split any profits from that bit of land with their new owners. The company gets a massive boost of cash from the sale of the land, which they can invest back into the business, and they also mitigate the risk of poor future harvests, turndowns in demand, by taking the dollars up front. Investors, meanwhile, get a steady income stream for the future. It's the perfect solution, is it not? Well, that's not how the SEC saw it, because to the agency, what they were selling seemed an awful lot like securities, which is a basic term to denote fungible financial instruments that hold monetary value. For example, a share in a public company. And that was a big-ass deal. Memories of the Great Depression and all its pain, unemployment, and horrible images of bankers jumping out of high-rise buildings were by no means a distant memory at this point in time, and the government wanted to ensure it never, ever, 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 ever happened again. As a result, the Securities Act of 1933 had been enacted, obligating that any issuers selling securities engage in a mandatory registration process, disclosing all the information of material importance related to the security. By requiring registration with a government body and the public having full access to the necessary information via a prospectus to make an informed decision, the aim was to cut down on grossly inflated financial projections and the possibility for rampant fraud. Following?
No fuss, no bother.
Okay, well, when it comes to a share in a business or debts in the form of bonds, it's pretty straightforward what is and what isn't a security. But what about land where oranges are grown? Surely that doesn't count. Well, it does count according to the SEC and, in 1946, the Supreme Court. Because the Howey Company's arrangement was basically an investment contract. Out-of-towners with no experience in agriculture investing just to make bank. And so there lay the real possibility of abuse if no one was watching out for any potentially wild promises being made.
You want your family to have the best, the natural vitamin C, the kind you get in canned orange juice from Florida.
To make all of this a hell of a lot clearer for everyone involved, the Supreme Court established 4 criteria, now collectively known as the Howey test, to determine whether an investment contract exists and therefore whether something is a security and has to be registered. The 4 parts are an investment of money in a common enterprise with the expectation of profit to be derived from the efforts of others. Let's break them down. Money is fairly self-explanatory, although today we're moving away from money specifically towards wealth or value instead. In a common enterprise can be understood in a few ways, either that investors are all putting their money into the same thing, or that the success of investors is intrinsically linked to the party being invested in, or that the investment itself is reliant on the promoter or a third party's expertise. with the expectation of profit, dissects investor intent. Are people looking to make a profit by doing this, or are they simply trying to store their wealth, like in a stablecoin, for example? Finally, to be derived from the effort of others. It's fairly self-explanatory. In this case, we're talking about citrus groves through the agricultural expertise of the Howey Company itself. And after that brief sojourn, let's get back to Solana. Mr. Mark Young's lawsuit alleges that the cryptocurrency fails to meet the Howey test because, and this is the thrust of his claim,
purchasers who bought Sol Securities have invested money or given valuable services to a common enterprise, Solana. These purchasers have a reasonable expectation of profit based upon the efforts of promoters Solana Labs and the Solana Foundation to build a blockchain network that will rival Bitcoin and Ethereum and become the accepted framework for transactions on the blockchain.
Now, you may have listened to that quote and said, yeah, I can personally see why it might make sense. I mean, the token did go from $2 to $2.40 in the space of a year. And they had active socials talking about what they were building, and the development team seems to be intimately involved in creating a thriving community of Solana enthusiasts. Why wouldn't it be a security? But if you think that, why is Ethereum not also considered a security? It had an initial coin offering in 2014 and raised $18 million over a period of 42 days, where people were buying in together on the collective expectation that the protocol would become a better alternative to Bitcoin and therefore would create profit as a result of the efforts of Ethereum's development team. This is all basically the same fight that Ripple Labs has been having for the last, nearly 2 years after the SEC sued them, claiming that they traded $1.3 billion in their cryptocurrency XRP as a security without registering it. Ripple, for its part, still holds the defense that the SEC is making classifications in an arbitrary and biased way rather than on actual merit or even clear and consistent rules. They say what Ripple does isn't materially distinct from what other projects in the space also do, so why have they been singled out? Solana Labs has so far declined to publicly comment on the lawsuit, but one could imagine them making a very similar defense when it comes to their turn in court. However, there's a alleged but big difference between Solana and Ethereum that can't be overlooked. Who owns the tokens? According to crypto research platform Messari and the lawsuit itself, some 48% of Solana's token supply was held by insiders as part of the initial token allocation, in contrast to Ethereum's 80%. This includes Multicoin Capital Management and Kyle Samani, who, according to the filing, relentlessly promoted Sol Securities after purchasing them for 40 cents in 2019. And that matters because it means point 4 of the Howey test, to be derived from the efforts of others, is more acute. Unlike a very decentralized blockchain such as Bitcoin, where no one party can unduly influence the value of the protocol as a whole, having a considerable insider and core development team stake creates a vested interest in promoting the token and an ecosystem where its success is determined by the hands of a very few. And without the SEC involved, who's going to guard the guards themselves? Now, the question I'll pose at this point to you is, does the minutiae of token distribution ratios and the like actually matter at all? Is there a spectrum of securityness one can slide around like one of those tricky corners on Rainbow Road? Shouldn't it be a binary choice instead? If public investors give you money to buy your token via an ICO or Dutch auction or anything else otherwise, under the expectation that the project will be a success and they're relying on your expertise to make it so, surely that's a security. Ethereum did this, so shouldn't ETH be a security too? No? The rub here, I fear, lies in the difference between what is regulated and what should be regulated. As the SEC chair himself, Gary Gensler, affirms, they believe their agency has jurisdiction over probably a vast number of cryptocurrencies currently in circulation, but maybe not Bitcoin, which as a commodity token would be better overseen by the CFTC. Everything else, even Ethereum, fair game. However, the long-awaited Responsible Financial Innovation Act, it sends a slightly different message. The bipartisan bill, introduced in the United States Senate on June 7th, has the aim of creating a regulatory framework for digital assets, and it talks a lot about working with the CFTC and the SEC to find the right mix of using the Howey test to figure out which of those agencies can best regulate. It also has the, quote, understanding that most digital assets are much more similar to commodities than securities. The bill gives the CFTC clear authority over applicable digital asset spot markets. So perhaps the repercussions of the lawsuit will stay pretty much with Solana after all. If the filing does go against the cryptocurrency, then we can probably expect a very similar playbook to what happened with Ripple, where all centralized exchanges in America, Coinbase, Kraken and the like, will delist the token and you won't be able to buy, sell or convert it. For me though, I find it hard to believe that other crypto projects won't now be starting to think long and hard about how they launch and market their protocols in the future, at least until such a time as a meaningful framework makes its way through the legislative process. But until it does, and until this court verdict rolls in, which frankly speaking could be a long time, we're all just going to have to go to the Winchester, have a nice cold pint of SEC registered orange juice, and wait for this all to blow over.
Right now, wouldn't you enjoy a cool, refreshing glass of pure golden Florida orange juice?
What do you think? Let us know in the comments below, and if you're enjoying this video, do give it a little like and thumbs up. All your love and support gives us a warm and fuzzy feeling and helps us feel good about making more videos in the future. Until next time though, look first, then leap.